All right, everyone. Today we're going to be getting a crash course in how to reduce your income taxes due if you are someone who owes taxes, how to increase your tax refund, how to avoid being audited, and what to do if you owe Uncle Sam. Know the difference between a tax credit and a tax deduction. A tax credit is a credit against taxes that are due. A tax deduction reduces your income. So in other words, tax deductions go against your top line income. Say you make 100,000, adjustments to that income take the income down to 80, say $20,000 of deductions. 80 is your taxable base. If you are, say, owe 20%, you're in a 20% tax bracket, your taxes on that be $16,000. Okay, that $16,000 is your tax bill. A tax credit would reduce that tax bill. Okay, so tax credits go against your tax bill, tax deductions go against your taxable income or your income. Okay, and I have some examples here on the screen. You can use your W-9, okay, W-4 form to reduce your increase or decrease your deductions throughout the year. That W-4 form is the form that you complete during your new hire orientation. You get one for the state and one for the federal, and basically you have to put in those numbers, and it basically has you put in a 1. It starts off if you're single, if you're married, and you go all the way down. The more numbers you put in on that form, the less they're going to take out of your check. The fewer numbers you put on that form, the more they're going to take out of your check. And that goes for both the federal and the state. So if you want to get a larger tax refund, then what you would want to do is you would basically adjust your withholdings by reducing the numbers on those forms, and they will take more out of your check. It makes no sense to do that when you have bills throughout the year, you have debts throughout the year that need to be paid. It's much better to have that money in your hand to pay those obligations, get yourself caught up, to get some debts paid down, to make some investments, versus getting a fatter refund that's not necessarily going to do you any good in the long run. Okay, 1099 people, I always tell you, if you're a business owner, make sure that you make estimated tax payments or you have a side tax account. That account is dedicated exclusively to your income taxes. So if you're self-employed, you need to be putting aside 30% of your gross income into a side tax account. That way, when you file your taxes and take your deductions against your income, you should always have more than enough money in that side account to take care of any tax obligation that is due come April 15th. If you don't do that, you can find yourself being in a situation as a business owner, which is very common. I cannot tell you how many high income earning business people make a ton of money, but they owe Uncle Sam a ton of money because they have not set aside 30% of their gross income in a tax account to meet that tax obligation. Make sure you do that. If you are if you're operating as an LLC and you're a business owner, you can do what's called a 2553, which is an S Corp election that will reduce your self-employment taxes. Okay, most business owners don't know that. Most of the times your accountant or person that does your taxes would not know that. But if you are operating as an LLC, you can do a Form 2553. That will help you some on reducing your taxes. Now, how do you avoid being audited? If you do a tax amendment, which is a 1040X, and you make adjustments to your income, meaning reducing your income or increasing your expenses, you're increasing your chances of being audited. Doesn't mean you are going to be audited, but you are definitely putting a red flag on your tax return. Excessive business losses without income offset, running expenses through your company and your company has no income, and you keep running a loss year after year after year, and you're basically just doing it to reduce your W-2 income. You're creating basically a dummy company. Not a good idea. You're increasing your chances of getting audited. Unfiled tax returns. Just because you don't file does not mean you do not owe. Uncle Sam has an account with your name on it, and when you do file your tax returns, they will be scrutinized much more closely because you will have to do a late 1040X or you have to basically go back and file for all of those years you didn't file, and that will become much more scrutinized. The more income you make, the greater your chances, okay, of being audited. If you owe the IRS, do not avoid the liability. Call them people up and tell them that, hey, you want to make a payment arrangement or you want to settle that debt, because if you don't, they can put a lien on your house. They can take the money out of your bank account, and they can garnish your wages.